Rob, good to have you back.
I know, it's been a minute.
Yeah.
It's good to be back.
I've had too many other people sitting in your place here the last few weeks.
Yeah, but I'm not sure if it was never necessarily my place. And besides, some of those interviews were really good. Really loved the one with Grizz. Of course, love Jake.
Yeah.
Happy to see that happen.
Yeah. I think we've had some great topics here that we've covered the last couple of weeks. But good to have you back to do our monthly market economic update and talk through things, just kind of the state of where we're at and what's going on in the world. And
interesting world we live in.
As always, wouldn't have it boring or any other way. I think maybe some timely, which it seems to be kind of the recurring theme this year, tariffs, inflation, unemployment, earnings, just kind of where we at? What's the state of the world look like right now?
Yeah, good question. I think starting with tariffs, certainly, I shouldn't say certainly, but it's more certain now than it ever was. Obviously, there is going to be this base level tariff. Some countries are going to be tariffed at higher rates, but that's really starting to take effect. I think what's a little less certain is what is this going to do to the economy and then to markets overall. Any projections that you have or any thoughts?
As we've talked about, I don't carry a crystal ball, so I'm not gonna, I think anyone trying to predict what any president might do, let alone President Trump, it would be really difficult to do. But I think he has swung that bat pretty well in terms of the threats, what he's put in place, what's going. He's done I think an overall good job with it.
Defied expectations.
Yes.
Everyone thought the world was going to collapse on itself, but here we are, still breathing.
Right. Yeah. Yeah.
People are still spending money. Yep.
Companies are making money.
Yeah. It's interesting because even with the CPI report coming out recently, everyone has equated tariffs to higher inflation. And I know you and I take a slightly different stance to that. The way that I think about it, going back to Milton Friedman, inflation is a monetary phenomenon, which means that you have more dollars chasing a single item, good, service. Tariffs are just a one-time price adjustment. So it's almost like a different mechanism. The example that I was reading about this morning equated it like this. If you were to throw a rock into a pond and see ripples, that's a tariff. That's a one-time change in price. Whereas full inflation is the water level rising altogether. And I thought that was pretty apt.
I think that's a great analogy. I like that. And, Yale just came out with a study saying, and their conclusion was that tariffs might overall affect prices across the board with all goods out there by about 1.5%. And only about 12% of our dollars, so call it 12 cents of every dollar, is spent on actual goods, whereas most of our dollars spent on services, which aren't affected really by the tariff situation. So, it's much less, but if we isolate that down a little bit, right, and look at tariffs across the board. So Yale says, okay, 1.5% increase in prices across the board is what they're seeing. Well, that's not that much. But when you isolate it down saying, okay, well, some companies aren't affected by tariffs and most probably aren't.
Yep.
But there are some that are. And some of those that are, they're affected a lot.
Yep.
Right. So, it's a case by case situation.
It goes back to the example that everyone's inflation rate is different. If you're not in the market to buy a car, well, then used car inflation isn't going to bother you too much. Same thing with furniture. Those are typically one-off style purchases. We have seen some parts of inflation data go down. So when you think about shelter, when we've looked at it over the past year, that's been a big part of the CPI. That is slowly starting to come down, which I think should help a little bit. But again, it kind of goes back to what will the Fed do? And now I think you're seeing the markets price in almost 3 rate cuts towards the end of the year. And I think that goes back to the difference between what is actual inflation versus a one-time price change. And I think everyone's going to be, or I shouldn't say that necessarily, but I think the market's going to work its way out. It
does. It always does. In the long run, it's going to work itself out, right? The short run, you can see anything and everything happen in the market. It can take off on a run. It can take an emotional dip, which we see often, or that dip that is caused by just uncertainty, right? Which happens often. But in the long run, it works itself out, which I think we're seeing some of that.
Yeah. So let's go ahead and complete the dual mandate here that the Fed has. Where do we see unemployment and what has that data said? Many of our counterparties at the beginning of this year said that labor data would be slow to show itself. And I think that's been very much true. What they had told us was instead of seeing a flat rise in the unemployment rate or participation, you'd simply just see job openings go away. I think that has happened. And with that, you've seen lower jobs being created, which you've had these massive revisions down. And that has certainly caught everyone's eye. Too early to tell whether that is going to cause stress with their dual mandate.
And speaking of the dual mandate real quick, which
please.
by the Fed is to keep inflation down and also keep unemployment
That's
low,
right.
Right.
That's right.
So that's their dual mandate.
Yep.
Right?
Yep. And sometimes they're a little counter to each other, which is a period we might be going into. Hence the pressure on them to lower rates to save the labor market, which I think they understand that they certainly have room to do. And I think eventually that they'll get there. When and the timing of that, I just don't know. I don't think anyone necessarily knows, but Fed fund futures market is, of course, everyone's best guess.
So everything's moving along, and when we look at that, any other items that, can affect, just kind of the market, the economy with what we're looking at right now. We seems like for the last several years, we've had some pretty good geopolitical tensions. We've got Russia, Ukraine, we have, the Middle East, we have different areas. Seems like those have calmed down a little bit.
Potentially. I've been shocked with how well financial markets have handled some of those geopolitical tensions. I think one of our advisors put it pretty perfectly a while ago in that there's a certain level of geopolitical tension that's just priced into the markets now. And I think we're going to have that for the foreseeable future.
Any other important areas that, that you see that might move the market? We're at a high in the market.
Yep.
Right. We've been on a pretty good run now since mid-April, somewhere there in April, on a pretty good run, maybe due for a little pullback.
I think I saw this has been one of the best non-recessionary bull markets we've had as of late, which is just a bull market not started with a recession. And if you look at it, I think we hit a correction, but not a recession in 2022, hence this new bull market. Yeah, it's been quite the ride. Ultimately, earnings matter. We've seen earnings revisions actually go up. I do have to caveat that with you are seeing more volatility. And what I mean by that is when companies miss earnings expectations, they tend to dip. Their stock prices tend to dip a lot more in general. And I think what that alludes to is a frothier market going forward. We always look to where risk is maybe a little mispriced. I would say when you start looking at volatility getting certainly very low, expect it to creep up. So with prices being high expectations, any sort of miss or any sort of event that comes out of nowhere to knock either markets or individual companies off their pedestal, I would expect big reaction.
Yeah, I think that knee-jerk reaction is going to be larger. I think you're exactly right.
Yeah, and people have asked us a lot with markets being at new highs, are valuations a concern? Sure, I think they are, but ultimately what our experience has told us is that market highs tend to lead to new market highs. Some of this goes back to where markets are at today with a lot of passive movement. So as long as passive flows are still positive, I would think that markets would still float upwards. I think the big risk that I would advise maybe our clients and ourselves to look at is maybe don't go swing for the fences for an investment that, well, this should just go up because. I would be pretty specific about the risk that I'm taking and why.
It's funny. I was reading an article this morning and I thought it was really interesting, talking about just high valuations. You look at a company like Nvidia that makes the chips out there they're trading at 58 times earnings.
Yep.
And they make up about 8% of the S&P, which is incredible. Now, going back, I went and looked, went and did a little research on this. When I started 30 years ago, the company, what was the largest company? My question was what I wanted to answer for myself was, what was the largest company on the S&P 30 years ago?
Can I guess at this?
Yeah, go for it. They're still around.
Exxon?
Good guess. They were right up there.
Okay. Walmart?
Oh boy.
No, all right. I've had two guesses at it.
Yeah. They held the title belt for a number of years. GE.
GE. Okay. I
GE.
should have guessed that one.
What I mean, that was a household name on a daily basis 30 years ago, right? And they held. Now they were trading what at the time was thought to be high, 8 times earnings, and they held.
It's an egregious valuation,
right? I mean, now looking back, you're like, boy, I'm maybe glad I didn't own more of that. But at the time, they made up 3% of the S&P.
Yep.
3%. And now today, GE is obviously not the same company.
3 different ones now.
Right. Yes. So when we look at that, you look at companies that when I started, there were also, 8,000 stocks to choose from. Today, there are less than half of that that are publicly traded, 3,800. So, a lot more money because of inflation that's been printed, all being funneled into less than half the companies out there. So those valuations are going to rise, right? And the valuations are going to rise. The trading, well above the earnings, rate that we were seeing 30 years ago. All that's increased. So a much different situation. Be careful about where you're putting that money. But that's, at some point here, it's going to pull back. Like when we saw in April, I mean, what a great opportunity to rebalance a portfolio, buy some things that were down, do some Roth conversions, right? Which are things that we did with a lot of the clients.
Yeah. As we always say here, markets can and will be and are markets. So expect the unexpected. To that point, markets, at least U.S. markets, do deserve a slightly higher valuation when you look at margins, especially operating earning margins. Going back the last 10 or 15 years, everyone thought that they would revert to the mean, call it mid-single digits, high single digits. I might be getting that wrong. Has not happened. Operating margins continue to go upwards, which supports higher valuations. So higher valuations on a market hold maybe doesn't scare me quite as much as when I first began my career.
That's exactly right.
Right. I think it's just a function of increased productivity with what we've seen in AI. I think things are going to become more productive objectively. And what every single earnings season has told us is the AI spend is still there. So as long as that stays intact, this could just go on for longer.
Yeah. Huge demand in energy, huge demand in that tech specific sectors in there, communications, different areas.
Yep.
Right. So,
and a lot of people have drawn corollaries to the .com bubble. I know you were right there smack in the middle of it. Yes, I can see some similarities, but I can really see some big differences too. All concentration ends in some way, shape, or form. I just don't know if it's going to be this valuation pop because I don't know if I see that.
I agree. The math isn't there at this point in time. So, keep buying quality.
Yeah.
Diversify appropriately.
Yep.
Right.
I completely agree with that.
Stick with our sound principles.
I think if anything going forward, if I were to make a big bet, I think diversification is going to come back in vogue a little bit. You're going to see investors roll into different asset classes. And yes, you still need S&P exposure in there because these are great businesses, but there are other good investments out there too.
That's right. And that's where our privates come in and we've got access to that area.
Absolutely. The half of the companies that you had mentioned earlier that went away from the public markets, they didn't just disappear. They're just no longer public.
Right. They're still there. Any updates to the portfolios? I know we we're going to be rolling out something that's available to our clients if they so wish to choose. And that comes with education and feeling comfortable and so forth with, we have our allocations from income conservative all the way up through aggressive growth. And then we've duplicated that and added in a Bitcoin allocation.
Correct.
With Fidelity. Do you want to speak on that a little bit?
Yeah. So very similar to some of the messaging that you've been delivering. What we've found with Bitcoin is it's not very correlated. It's still a risk on assets. So the correlation is still positive. But when you go back and look at various time periods, the S&P or even the NASDAQ really only explain a fifth of the movement of Bitcoin. So it is a differentiator for better or worse. And to kind of pull the Jamie Dimon line a while ago, like maybe I don't understand it all right now, but a lot of very important people and smart people are telling us to pay attention to it. And of course, I understand it a lot more now, but does it deserve a place in a diversified portfolio? Yeah.
Yeah, I think so. And the purpose of any investment, let's outpace inflation over time. Right?
Yeah, absolutely.
And I think there's a good opportunity here to have that mixed into the portfolio to help enhance the probability that we can outpace inflation over time.
Yeah, that's always the goal with any investment. I agree completely. Yeah,
that's it.
100%
Very simple. So, and Fidelity's created some nice ETFs.
Yes, they have.
Which they've been in the Bitcoin space for
longer than I would have thought. Maybe I wasn't paying attention close enough on that, but I was kind of surprising to hear some of that.
Yeah, kind of around the 2013, 2014 time frame when they started mining. Yes, quite surprising on that end. So they have a pretty good depth of knowledge and experience on that end that we're leaning on.
Yes. Yeah, absolutely.
Great. Any other talking points around the market and the economy?
Great question. I don't think so. Nothing off the top of my mind, but as always, we're always watching.
We're always watching. We're always here. You're always at the wheel with a cup of coffee and wide-eyed on it.
Yeah,
so.
I think exactly. And we got a great team here.
Although quality coffee.
Quality coffee. I'm a little bougie when it comes to coffee.
Yeah. You start at the good coffee beans, grind them up. You've got to have it the right way.
I always refer to it as a relatively affordable luxury, but the price of coffee's gone up quite a bit. Yes. It's still affordable, but I'm not going for the cheap stuff. I like my expensive stuff.
Yeah, agreed. Quality over,
which I know you appreciate too.
I do. Yeah, you've kind of pulled me in that direction, and I appreciate it.
You go through decades of your career going towards K-cups or even other types of machines, and it's just not even close to the real stuff. I have few vices. That's one I'm going to hold on to.
I don't have as many late nights with the company as I used to. I'm not grinding quite.
It's a good thing.
100 hours a week any longer now. Hey, 70. Let's go with 70, right? And not as many late night 9 p.m. coffees any longer. But if I would have appreciated those good coffee beans back then a little more.
Of course. Any last closing remarks from you or anything that you want to cover?
Making sure that we have a plan in place across the board. We're diversified. We're being tax aware, tax efficient in what we're doing on a daily basis. Making sure we have an updated estate plan and, just everything across the board. It's the full plan. It's the full approach. So we just have to keep doing that. I think taking our philosophy with wherever the market's at, good or bad, that we've got a good diversified portfolio. And, we're just taking that proactive approach to buy quality and stay the course.
Yeah.
So, well, super. We'll take this on next month. We'll see where things are at. Yeah.
Sounds good.
Yeah. I know coffee beans will still be good. We'll see what's going on in the market at that point.
Hopefully those don't rise too much more, but we'll see.
Yeah.
I'll still buy.
Awesome. All right. Well, thanks again, Rob.
Yeah. Thanks
See you next month.
See you next month.